Let's start with something nobody really wants to say out loud. Saturday morning, the United States and Israel carried out coordinated strikes on Iranian military and nuclear facilities. And about 45 minutes after the news hit, somewhere across the world, a trader in Singapore was already jumping into oil futures. Not because he's a bad guy, that's just how markets work. Welcome to geopolitics, where the worst day of someone's life can end up being someone else's best trade. I'm not here to tell you if the strike was right or wrong. That's way above my pay grade. What I'm here to do is break down what actually happens to your money and the global economy when something like this goes down. Because whether you own stocks, keep an eye on inflation, or just fill up your gas tank, this affects you, probably more than you think. Let's rewind for a second. Geopolitical shocks, the fancy term for something just blew up and now everyone's freaking out, usually hit markets in three very predictable phases. Phase 1 is immediate panic. Investors dump risky assets fast. Stocks slide, fear spikes. This is what's called a risk-off move, which sounds fancy but really just means people are scared and running for safety. Phase 2 is the commodity surge. Oil and gold shoot up, because when the world feels like it's on fire, those assets suddenly look very attractive. Phase 3, and this is the part most people miss, is recovery. Once things settle down and traders figure out the real damage, markets usually start clawing their way back, often faster than anyone expected. We've seen this exact pattern so many times it's almost predictable. Gulf War, Iraq War, the Russia-Ukraine escalation, every single time the initial panic eventually turned into a rebound. So here's the uncomfortable part. If history repeats itself, this event, as serious as it is, could end up being a buying opportunity for people who don't flinch. Markets can be pretty cold like that. Now, why does Iran specifically trigger such a big reaction in markets? Most people hear Iran and think ballistic missiles. Fair enough, but traders hear Iran and immediately think about one thing: the Strait of Hormuz. If you've never heard of it, picture this: a narrow stretch of water about 21 miles wide at its tightest point, sitting between Iran and Oman. On a map, it doesn't look like much, but about 20% of the world's oil supply moves through that strait every single day. 20% of the entire global oil supply through one narrow waterway. If Iran mines it, blocks it, or even just threatens it, oil prices don't slowly move up, they spike hard. And everything connected to oil, transportation, manufacturing, food, plastics, heating, starts getting more expensive almost immediately. Energy traders don't wait for missiles to land. The moment the headline drops, they're already pricing in the risk. That's exactly what you're seeing in oil futures when events like this happen. Now, let's add another layer, because this situation has a complication most conflicts don't. Reports are circulating about the possible death of Ali Khamenei, Iran's supreme leader. Now, I want to be careful here because nothing is confirmed at the time of this script, but from a market perspective, the question isn't whether it happened. The question is whether investors think it could have happened. And right now, they do. A leadership vacuum in a country that controls 20% of global oil transit. That's what analysts call a compounding uncertainty event, which is just fancy language for things just got a lot messier. Political instability in Iran triggers a very specific chain reaction in markets. Sanctions could change. Oil production could get disrupted. The currency takes a hit. And whenever something that big is in flux, money starts moving, not into productive assets, into defensive ones. Gold, U.S. Treasury bonds, anything that tends to hold value when everything else is shaking. Investors don't hate risk because they're cowards. They hate uncertainty because uncertainty can't really be priced. Risk can be modeled. Uncertainty is just a blank page. And then Iran responded. Missile and drone strikes targeting U.S. military installations in the region, which means this isn't a one-sided situation anymore. Now it's an active exchange. Here's what that means for markets beyond just oil. Shipping routes across the Middle East suddenly become a liability. Aviation corridors that normally fly over the region get rerouted or shut down. Global logistics, which was already fragile after COVID and the Russia-Ukraine disruptions, now has another unpredictable variable thrown into the mix. This is what traders call the geopolitical risk premium, basically an invisible surcharge baked into the price of commodities and certain sector stocks. When conflicts escalate, that premium rises, and it doesn't just show up in oil. It shows up in defense stocks, airline stocks, shipping companies, and supply chains for manufacturers that rely on parts coming from regions that suddenly can't guarantee delivery timelines. The interesting thing about geopolitical risk premiums is that they benefit a very specific group of investors while quietly taxing everyone else. Defense contractors love this stuff. The average consumer just ends up paying more for everything without really knowing why. Let's talk about who's lining up on which side, because geopolitics today isn't just about military alliances anymore. It's about economic blocs. The operation reportedly had backing from the US, Israel, the UK, and Canada. China and Russia condemned it almost immediately. For investors, that divide matters more than it might seem at first, because China and Russia aren't just political players. They're major forces in global commodity supply chains, alternative trade routes, and currency systems specifically designed to operate outside the US dollar network. If this conflict deepens and those alliances harden, we could see ripple effects across sanction structures, global trade routes, and even the dollar's role in global energy pricing. None of that is guaranteed, but none of it is off the table either. The global financial system has been quietly splitting along geopolitical lines for years. Events like this tend to accelerate that split. Now let's zoom in on the real economic landmine here, and it's not the missiles, it's inflation. If the Strait of Hormuz gets disrupted, even a little, even temporarily, oil prices go up. When oil prices go up, transportation costs rise. When transportation costs rise, moving goods becomes more expensive. Manufacturers pass those costs to retailers. Retailers pass them to consumers. And suddenly your grocery bill is higher, gas costs more, your Amazon delivery gets more expensive. None of which has anything to do with anything you did. You just happen to live in an economy that runs on oil. That puts pressure on central banks, because higher inflation usually means higher interest rates. Higher rates slow borrowing, cool down the economy, and make stock markets nervous. So you get this ripple effect. A military strike in the Middle East can eventually influence whether the Fed raises rates in Washington. It sounds like a stretch, but it really isn't. Energy inflation is one of the stickiest and most disruptive forms of inflation because it feeds into almost everything. Now, let's look at how this could actually play out. Financial analysts are already modeling scenarios, and they're surprisingly specific about it. Scenario 1. The Iranian regime survives. Analysts give this about a 50% probability. In that case, the initial shock fades, oil stabilizes, and markets recover within weeks. This is the classic buy the dip outcome. Messy in the short term, but noise in the long run. Scenario 2, a new revolution or regime change, roughly a 30% probability. This one's more complicated. Oil supply disruptions could last for months. Regional instability spreads. Recovery takes longer, and there's real economic damage along the way. Scenario 3, country fragmentation, around 20%. This is the scenario nobody really wants to price in. Long-term geopolitical instability, constant commodity volatility, and potentially permanent disruption in a region that sits on a huge chunk of the world's energy infrastructure. Most investors are quietly hoping for Scenario 1 while hedging for Scenario 2. Almost nobody is seriously pricing Scenario 3, which might be rational or a little naive. Probably both. Here's something worth thinking about. Historically, wars don't crash markets long-term. That's not a comfortable thing to say, but it's true. The Gulf War, the Iraq War, even the Russia-Ukraine conflict, in each case, markets took a sharp hit and then recovered, sometimes within months. This gave rise to a very popular investor strategy called buying the dip, which basically means when everyone panics and sells, you buy, because panic is temporary and recovery usually follows. And it works, surprisingly often. But there's a quiet asterisk attached to that strategy. It works best for people who already have capital and can afford to wait. Regular people who get hit by higher oil prices, higher grocery bills, higher rent, and more expensive gas, they experience the inflation but don't necessarily get the recovery trade. They take the punch, they don't always get the bounce. Geopolitical shocks have a way of concentrating the pain while spreading the gains very unevenly. Markets recover, prices don't always come back down. So where does that leave us right now? Investor sentiment heading into this week is moderately bullish, somewhere around 5 to 5.7 on a bull-bear scale of 1 to 10. Not euphoric, not panicking, more like cautious optimism with one eye glued to the headlines. But the real variable isn't just the conflict, it's the economic data coming out over the next few weeks. Jobs reports, inflation numbers, signals from the Federal Reserve. Markets can absorb a military strike. What they struggle with is a military strike plus rising inflation plus a Fed that decides it has to raise rates again. That combination doesn't happen often, but when it does, it's ugly. Here's the question I'll leave you with. Markets have already priced in the shock. They're pricing in the risk premium. They're modeling scenarios for oil, inflation, and regime stability. What they haven't fully priced in yet is the possibility that this isn't a contained event, that it might be the beginning of a longer, more complicated reshuffling of alliances, trade routes, and energy dependencies. History says recover and move on. The data says buy the dip. But the whole idea of a dip assumes the bottom isn't that far from where we're standing. The real question isn't whether markets eventually recover from this. They almost certainly will. The question is what the world looks like on the other side, and whether the economy we recover into is the same one we just left. Nobody really knows, and that, more than any missile or market move, is the thing worth watching.